Okay, we're now going to have an interesting panel discussion on financing innovation, moderated by Professor Antoinette Schoar. Antoinette is the Michael Koerner Professor of Entrepreneurship and a Professor of Finance at Sloan. She's an expert in corporate finance, entrepreneurship, and organizational economics. Her current research is in the areas of entrepreneurial finance and household finance, and this year, Antoinette has the honor of being head of the MIT Sloan Finance Group. So I'd like to welcome Antoinette up, and she will introduce our panel.
Thank you, Eric. And thank you to all of you for being with us today. It's a true pleasure. And in particular, it's a great pleasure for me to be here on stage with an outstanding panel of investors. We have three very experienced investors who actually among them reflect, if you want, the whole value chain of investing in innovation and technology. So let me get right to it. Bernie Horn, to my right here, is the founder and president of Polaris Capital. It's a Boston-based value investment firm. It represents, as you will see, he will talk about the public market side of investment in innovation. To his right is Greg Simon. He is the CEO of Poliwogg. This is a financial service company that in particular works in areas of healthcare and life sciences. He has seen the life science and healthcare industry from many perspectives. He's been in the White House, in Congress, a consultant to the life science industry and an investor in this industry as well. And to his right is Ray Rothrock, who currently is the chairman and CEO of RedSeal, which is a $25 million a year cybersecurity company. But before that, he was a partner at Venrock, a veritable venture capital firm in the US. And he also was the head of the NVCA, the North American Venture Capital Association. And he will share a lot of his knowledge from the very early stage side of financial and investment in innovation. So let me, please help me welcome our panel on stage. So, to get us started, I wanted to put forward a bit of a controversial thesis, if you want, that has been batted around recently about innovation and financing of innovation in the US, right? There's a lot of concern, if you look at recent debates in the newspapers, that while there is investment in innovation, we are not getting the right investment, and we might not even get enough investment in innovation. So Peter Thiel, in his typical and very flamboyant way, has coined this phrase that some of you might heard about the fact that, we wanted flying cars and we got 140 words, right? Meaning Twitter. So, this is exactly the spirit which, if you have looked at the Financial Times, even Wall Street Journal, recent debate, there's a lot of this worry that is something broken in the US model of investing in innovation at the early stage, as well as potentially, in follow-up investment, in later stage investment, and even the public markets. And so I wanted, kind of to pose this question first to Ray, who has seen, as an investor in private firms, and from the perspective of the NVCA also, kind of what do you think the story here is?
Okay.
So
good afternoon, everyone. I've got just a handful of slides here. I think sort of frames up the whole industry and what's been happening. So most people associate the Silicon Valley with venture capital, or venture capital Silicon Valley. It actually happens everywhere all over the world. I started in New York City, just over at 30 Rock on the 55th floor, working for the Rockefellers back in the 80s, before Silicon Valley was barely even named Silicon Valley. So it's been around. But it is very significant. If you look at just that list under the green banner of the number of Fortune 500 companies that were venture-backed, going all the way back to Hewlett-Packard, but there's Cisco, Applied Materials, Franklin Resources. These are names that aren't popular anymore. Apple, of course, is popular, and Intel, Cisco. But these top 50 companies have an enormous revenue base. 50% of the whole Indian GDP, 6% of the U.S. GDP. They employ all venture-backed companies employ 11% of the private sector jobs in the United States. It's an extraordinary engine for innovation. Next. So there are three things that go into a startup. First of all, you got to have an entrepreneur, someone with an idea or the ability to focus on a problem and attack it. Venture capital comes into play when you're going to work for a while on the solution and you don't have revenue, so you got to pay the bills, pay the electricity or the Amazon cloud services or whatever it is these days. But most importantly, you have to have science and technology or other innovations, business model innovations, for example. Just one comment, though, about it. A big source of concern in the venture industry is the continued decline of R&D in the United States. The government spends about $110 billion. Industry spends about $400 billion. That's about $500 billion, which is not even 1% of the U.S. GDP. Pretty scary. Next. So if you look, there's whole industries have been created by venture capital investments. These were really created by entrepreneurs who were backed by venture capitalists. Software, biology, semiconductors, Moore's Law. I was just at the celebrating Gordon Moore's 50th anniversary of his famous law. He was at the Exploratorium, and believe it or not, at the age of 87, he is as lucid as all of us in this room, and it was really an exciting time. But semiconductors power everything. In fact, now it's even powering healthcare. Next. So VC funding. Well, if you go way back, when I got into the business in '88, it was less than $1 billion. And you can see in 2000, it topped off at $100 billion. Name me one industry in the United States that goes from 1 to 100 in 12 years. It's never happened. But it did here, and of course, we know what happened after the fact. It looks like we got a little bit of a dead cat bounce there. They'll bump up and bump down. But what's going on is the money is coming back. Next. So this was the most astounding. When I became chair, we dug into this a little bit more at the NVCA. But given all the money, whether it's a lot or a little, there's only about 1,000 companies survive out of the 20,000 or so that get started, whether it's with a venture capital fund or an angel. Only about 1,000 to 1,500. And that hasn't changed in the last several decades. That's the source of innovation and new value in the country. Go. So it's skyrocketing. It's headline news now everywhere. Money is flowing in at extraordinary valuations. Big money's flowing in at extraordinary valuations. Next. IPOs have come back. If you look at 2008, after the crash, we had a whopping 7 IPOs. 7. Back in the 80s and 90s, it was about 130 a year, 140 a year. Now, we're just now getting back to sort of something in the hundreds. But what's interesting is that the value or the capital that's taken out of the public market and put into these companies is very, very concentrated. I mean, Facebook's IPO is $16 billion out of a total capital consumed from the public to the private of just less than $25 billion. So this is happening more and more, and undoubtedly when the Ubers and those guys make it to the public markets, we'll see similar trends. So there's a great deal of concentration in the public market on a few deals. Next. And then, of course, the best advice I ever received from the Rockefellers was hope for the best and prepare for the worst. And here we have a Prius with an electric generator on the back, which is kind of the way I like to operate. So there.
That is brilliant. Maybe we should all operate more like that. And Debbie will tell us how to actually account for the costs of doing that. This is a really interesting summary of the recent developments, right, in this industry. I wanted to ask Greg to maybe pick, his industry, in particular life sciences and healthcare, and comment on whether you see very similar trends in that industry or whether this industry is actually developing quite differently, because, there has been a lot of concern that, healthcare, with also lots of government intervention, maybe might have different cycles than the rest of the industries.
Thank you, and thank you for having me. Let's keep in mind how the venture capital industry got started. It got started because ERISA allowed pension funds to invest in stocks, and the public markets didn't provide the return they wanted, and so they basically demanded a venture industry be formed to allow them to invest in the private economy. Well, that's changing. Our lunch speaker, Mr. Kogan, mentioned that In 1900, if you owned stocks in the New York Stock Exchange, well, in 1900, you couldn't go buy a stock. You had to give your money to a trust company, and the trust company bought the stock. Well, today, with the Jobs Act that passed in 2012, we have had the biggest revolution since Roosevelt, because the Jobs Act is to private securities what the 33 Act was to public securities. It opened it up to public ownership. And the Jobs Act is opening private securities up to public ownership, both by allowing companies to have more accredited investors without having to go public, and also by allowing certain kinds of companies referred to as Regulation A companies, private companies that agree to go public in 5 years, to have an unlimited number of accredited and non-accredited investors, which means that in the next 5 or so years, the only difference between private stocks and public stocks will be the number of shareholders. Let me repeat that. In the next 5 or so years, the only difference between public and private companies will be the number of shareholders. The venture capital industry in health is already walking dead. And here's what I mean. If they operate at peak efficiency, which in the health space is about $6 to $7 billion a year, they cannot fund all the opportunities emerging in health. The NIH spends $30 billion a year on 300,000 people. They estimate 10% of those people are developing ideas that will have commercial potential. Let's assume there's only 1%. That's 3,000 a year. The current venture industry in health is only funding about 500 to 600 companies a year. Where are those other companies going? Down the toilet, basically, in the valley of death. What is the valley of death? When you've gotten a grant from a foundation and you've raised money from your family and now you need $2 to $10 million, no VC is going to even talk to you. They want to wait until you need $20 to $40 million and you're closer to the winner's circle. They're the only group that gets to bet on the horse just before the finish line. But what's really needed, this is what I call immaculate conception investing. Those horses can't get to the finish line if somebody didn't breed them and bet on them early on. And that's where the public is going to start having an impact. That's what Poliwogg does. We allow accredited investors and soon non-accredited investors to be able to invest in the private companies in the health space based on their interest. So even if the venture industry remains totally viable in health, it will always be too small. It is always too late stage. And we're considering the benefits that we have gotten from the health industry with the minimalist funding we've had so far. The new era of funding in biotech and life sciences is going to create value that you cannot imagine right now. And I'll come back to that point when we ask later, is biotech a bubble?
Just so that you already know. Thank you very much. So this sets us up really interestingly, because in a way are you saying that Bernie should start being really worried because kind of public markets are dead? Bernie, how do you think about this?
Well, and I think one of the things that I bring in this panel is a perspective from the public equity side, right?
Right.
In addition to that, when I started my first company in 1980, that was right after Sloan, that's my 35th anniversary is coming up next weekend, that when I looked around the world, there were about 2,300 companies and about 2,500 companies in about 23 countries that was sort of like the world market at the time. And starting a business up in Kendall Square, Mitch Kapoor was in my new enterprise class at Sloan. Of course, he went on to become, at least in 80s terms, fabulously wealthy. So the public equities and being in the public equities was sort of really felt like being a second child to the venture capital industry, certainly around 128 and so forth. But as we kind of looked at the innovation provided by venture capitalists and private equity, each year we meet with hundreds of companies and we ask them, hey, how's business? And then we get around to talking about things like, what are you doing with your R&D and how much you're spending on capital spending. The cumulative total of all these companies spending all this money, to me, always represented a tremendous source of innovation and to some degree, disruptive technology. Now, the default assumption about public companies is that they, destroy jobs, and B, only spend money to protect their entrenched technology and don't, so that nobody else can sort of do that. But the more you talk to companies, the more you find that they're all trying to eat each other's lunch as well. So Continental, the German tire company that also makes ABS brakes, I mean, they spend a lot of money trying to steal business on the frame of a car to incorporate more and more onto the ABS brake system so that they can replace somebody else's parts. So there's quite a lot of work. So if you fast forward a little bit, the interesting thing that happened around the turn of this century is that it was about 2012, 2013, I was looking at our stock screens and recognizing that there were a lot of companies that I hadn't recognized before. And I was trying to understand, well, where did all these companies come from? So I asked the staff, why don't we go back, like 10 years at the time to 2000, 2001, and look at all the companies passing our screens, and had anything changed in our screening methodology or our methods that was somehow bringing different companies into the screens. And so when we did the numbers, it was surprising to me that in 2001, this slide shows there's about 15,000 companies in the world to invest in. And if you go through to 2014, we now have about 40,000 companies in the world to invest in, public companies. And this slide breaks it out by market cap. And you see that companies with a $5 billion market cap and greater are an extraordinarily small slice of the public equity market. A $5 billion company is not a big company in the grand scheme of things. And in fact, companies over $20 billion, that very, very tiny slice at the top of the bar, the $20 billion companies are really small. They measure in the hundreds. So it struck me as strange, and now we're seeing that 92% of the non-U.S. universe and 91% of the global universe has a market cap that's $3 billion and less. So the other thing, when I was getting ready for this panel, I tried to take another slice at this growth. So we've got what, 25,000 new companies in the last decade or so. Where'd they come from? And the answer is that the U.S. I just did some more numbers, but in 2001, we had about 3,000 companies in the U.S. It's about, in 2014, it's about 5,300. So it was a net increase of about, let's say, 2,300 companies. Obviously, some companies went away, some companies were new. Google, one could argue, was a new company, right? And it's a big company right now. In Japan, it's up about 1,100 companies. But then when we look at other areas, China, India, for instance, has gone from about 400 companies in 2001, and now there are about 2,800. So an increase of about 2,400 new companies in India. Similarly, in China, about 2,400 new companies. And then if you look at the Cayman Islands, which is a place where a lot of Chinese companies register, there's another 800. So you could sort of say, well, 3,200 new companies. So there's a tremendous number of new companies being created around the world. And why is that happening? Well, if you look around, just in our myopic view of the world, 128, right, around Boston, a lot of the companies like Teradyne and so forth, they've gone to, we all know this is the manufacturing has gone to China, and the supply network, the small companies that supply them, and by the way, a lot of the innovation that goes to support this new product development has also gone offshore. So, so from our perspective, there are thousands and thousands of new companies being created, many of which are really small market caps. And if you venture capital back a company and you look at the pre and post money valuation, it's not unusual to have like a multi-billion-dollar valuation in a venture deal. But a lot of these companies are a lot smaller than that. So I think it's an interesting place. So the question is the U.S. Innovating more and more? I would say, yeah, absolutely. But it's being dwarfed in some ways by the new company creation around the rest of the world, and that's causing kind of a lot of disruptive technology. And as a value manager, just to close the loop, when we look at large cap companies that are really, really cheap, we worry an awful lot about the disruptive technology. The reason that a lot of large cap value stocks are cheap is because most people are worried that their business model is going to get knocked off the block and they're going to get put out of business because of some new technology. And sometimes that happens and sometimes it doesn't. So.
Thank you very much. I mean, you're pointing out a really interesting dichotomy, right? On the one hand, you're saying with the development of international markets globally, we see many more public firms in emerging markets, right? Which might be new creation, might be actually firms that used to be private, now actually becoming public in places like India and China, right? But then, of course, in the US, and I think Greg hinted at this too, there's a bit of a concern that, and I don't know whether, I pose it to you, whether it is a concern, kind of that actually more of the value creation of young firms is captured at the stage that they're private and not so much when they're public, right? So Greg, you were saying this, in terms of this idea that, now we can have much more private investor involved at the private stage, right? And some people, obviously, Uber nowadays or I should say it the American way, Uber, get quoted all the time, right? But they are a private firm with a $50 billion valuation. Now, if you look at some of the recent IPOs, you can see that the step up in value from the last private round to the public rounds is much smaller now than, maybe if you looked at these similar type of IPOs 20 years back, right? So my question to all of you is, are you concerned? Do you think it's a systemic change in how innovation is funded in the US? Is it something to be concerned about? Is it a good thing?
Well,
Ray, do you want to start?
So the MVCA data, and I haven't looked very recently, but it was 90% of the value, total value, was created after going public. So let's say you go public at 100 million, and and then $1 billion later. That was sort of the Cisco story. Then you look at Facebook today, if I can remember the numbers correctly, it was 80 billion, and now it's trading at around 300 billion. So a very, very different growth ratio. But if you look at the number of companies going public, it's far fewer. So there's a more narrow spread, but across fewer universe. So if you look at the pie, I still think it's in the 90, 85, 90% range where all the value is created. It's also where all the employment is created as well. I just want to touch back on this manufacturing. I grew up, my dad was a machinist, and we took tours of every manufacturing facility I could get my hands on when I was a young boy before I became an engineer. And, automotive plants were 10,000 employees and all this stuff. Go to the Tesla plant. Look at the robots. Manufacturing is not gone. It's just not humans anymore. It's very different. So there's innovation involved there, and talk about the supply chain. I just wanted to get that in there because I think MIT just they just released a big thing about manufacturing in the United States. So it's worth considering because it was talked about in the previous slide how innovation, right, is sort of, there's the haves and the have-nots. So it applies here. Sorry, I'm off track, but anyway, it's good stuff.
Go ahead, but I will pick up on this.
So it's really about the continuum of how you start innovation and how you grow it. You may have seen the New York Times story this week that people are upset that the government does a lot of research and then the private markets profit from it. And they use SpaceX piggybacking off of NASA and biotech companies piggybacking off of NIH. Well, as a liberal Democrat myself, I'm always embarrassed when liberal Democrats say the government should go in and capture the benefit from the private sector of benefiting from public investment. The whole point of the public investment was to create private profit. NASA for years said, don't criticize us for spending your money going to the moon. You got Tang, you got transistors, you got space blankets, you got all this stuff you wanted. NIH says, don't blame us if your cancer drug makes money for a company because they used something that was discovered at NIH. We're not a drug company. We don't do that. We can't develop those things. So the question is, how does the public both fund and benefit from the innovation funded by the government? The answer is not controlling the cost of new products or recapturing profits. The answer is letting the public invest in private companies that are started based on government research. When Facebook was at $1, only the wealthy could invest in it. Who did they sell it to when it went public? All the public people who were not allowed to invest for $1. So the government types say, well, we shouldn't let the average investor invest in private companies. They're really risky. And to which I say, hold it. You just said that all these people are getting rich off of government research, but you don't want everybody to have that chance because it's so uncertain. Pick a side. Either people are taking really risky bets using government research, and only the rich should be allowed to do it, or everybody should be allowed to do it because everybody should have the right to invest their money as they please in the private economy just the way they can in the public economy. And with the internet and social media and the transparency that cleaned up eBay, that lets PayPal thrive, we will have a very different private market than we did when people went door to door with a bag of stock and talked to widows and orphans. Those days are over. The reason Bernie Madoff was because he had a series of private conversations. He could never have done what he did by a public offering of a private stock on the internet.
Did you want to go on?
Yeah, I mean, I guess maybe I could have one more slide, my last slide on that.
Sure.
On my slide. I just wanted to kind of reemphasize the...
it doesn't go back. Does it not go?
Go forward. Yeah, there.
Okay.
I see.
No,
Yeah.
it does something.
But the point of the slide will make is that what's the impact of? Yeah, here's the slide. So this is just the sum up of all the publicly traded companies in our database, about 40,000 companies or so. So you can see the total market cap of this worldwide is about $52 trillion, which is not terribly far from what the 40 trillion or so of the MSCI World benchmark is, of which the US is about 27 trillion. But the total sum of R&D spending around the world, $740 billion, of which the US is just under 300, and capital spending, which is an enormous amount of money, 3.6 trillion worldwide, of which $1 trillion is in the US, and then M&A spending, which you could argue, is not clear. But I think, again, just to emphasize, there is a tremendous amount of money being spent, and this isn't just like a one-shot deal. I mean, every year, these companies are spending this much money. I mean, that CapEx is going into a lot of plant and equipment, and the R&D money is an enormous amount of money. So I think there is a lot of work. I think a lot of work being done in innovation and trying to create more new products and kill other people's products off and create new. But it really is astounding how much money is being spent every year.
So, thank you. To pick up on kind of what you all mentioned before, though, is it seems there are many new models evolving of how innovation is funded, in particular in the US. Part of it seems to be in response to also very different technologies that need very different initial capital investments that are coming up. So, Greg was describing Poliwogg. Many of you will be familiar with AngelList and Kickstarter and, obviously crowdsourcing type of platforms, right, that seem to allow a very different model of funding innovation. And some people actually call it even invest to fail type of models. So some of you will be familiar with this idea that, if you look at how lots of angels nowadays invest, is that initially they invest in non-priced rounds, right? Which means they actually give convertible notes where the pricing will depend on the first A round, so the first true VC round, that then establishes the price, right? And this is exactly where, when you talk also to journalists and even some of the VCs, they will say this is a very worrisome trend because it basically means that investors don't even bother doing due diligence anymore. They're just throwing money at a number of entrepreneurs, and then they will see who survives or at least, has a little bit of first roots, right? Then we let all the others fail and pick the few who actually, kind of go somewhere. And I wanted actually to pass this to the panel and ask you, is this a fair description of where a lot of the innovative activity is going? I mean, we definitely see, right, that in the kind of tech space, in the social media space, that seems to be true. And then, how do you perceive this, right? Is this an efficient way of investing? Is this a sign that income inequality has become so big that some people don't know what to do with their money anymore, right? Where do we stand?
So, yeah, that's true, they don't. But, I retired from Vinmark in 2013. I've done 17 angel investments subsequently, in so basically 2 years. And one that I did that some people thought was not invest to fail, but invest for charity, was Nest.
Yeah.
So that turned out pretty well for me, and so it was not charity at all. But there's a positive and negative. I think the big positive is picking up on the point about there's a whole bunch of people now that can participate. And you know what? That information flowing makes people a little more honest and stuff. The unfortunate thing is now with all that capital and liquidity, the deals are oddly shaped. They're not perfect. And one of the things that I've learned in all my investing career is that when the interests are not aligned, you have friction and you lower your chances of success. So if I put money on a debt deal with the hope it is converting to equity later, I'm not aligned with the entrepreneur. I'd rather be aligned with the entrepreneur right from the beginning all the way through to the end. And that disassociation with alignment, if that's such a phrase, worries me. And we saw a lot of that. When some of these organizations came in and started buying founder shares for companies that were long in the tooth, that began to break up what interest. I couldn't, as a professional investor, I couldn't sell my shares, but they'd buy the founder shares. Mm-hmm. So suddenly our interests are fuzzy. So what's your point? Is my point to build a big company, or is it just to get a quick flip of a 10x on $10,000 or $50,000? Right. And I think that's a key question that all this job stuff, and I was there for that, we'll see how it sorts out, I guess is how I would phrase it.
Yeah. I totally agree with that. First, I've had a lot of people throw things at me. Money was not one of them.
Also, it's not so clear what image that actually pervades when somebody...
But I think Silicon Valley has its own little precious culture, and if 2 or 3 big names decide to only do convertible notes, everybody does convertible notes. Valuation is an art, not a science. And I can give you unending examples of companies who are worth so much money now that nobody would have valued early on. Nest may be one of those. The company Markit, M-A-R-K-I-T, started the ABX in 2006, roughly. Do you have any idea the notional value traded in their 1,100 indexes today? $10 trillion. Now, if they had told anybody that in 2006, they would have thrown something at him and it wouldn't have been money. So there's a lot of value out there that you can't capture by valuations early on or convertible notes. But I totally agree with what Ray said. You've got to be aligned with the company. Especially in the life sciences, you've got to be patient and you've got to realize that there are enormous changes going on. As was mentioned, Moore's Law has finally hit health after all these years. It's the last sector for Moore's Law to have an impact. And that combined with the genome, and that combined with new cellular and molecular techniques and genetic techniques is changing the world, which I will come back to when you ask if biotech is a bubble.
I will keep you in suspense. I keep you all in suspense. Bernie, let me, however, ask you, as in a way, for everything that Ray and Greg said so far, right? Your market is in a way the exit, which means, in a way, it should be public market investors who should be most worried if indeed it's true that there are these misalignments of incentives. Is that something that you feel public investors are looking more and more at when they're seeing the private-public transition? Is that something that you feel has massive impact on valuations going forward, and how do you deal with this?
Yeah, I think it's always a struggle as a public equity investor to buy something from somebody who's selling, right? Because in the public markets, everybody the information is more or less pretty good, and you can match your wits up against the seller. in the particular case when we're even things coming out of private equity, clearly the seller has more inside information than the public investor has. And then I think it's from a valuation point of view, and how do you value the call option, the embedded call options and all these things? I mean, how is it possible that people didn't pay the right amount for Facebook when it was originally, clearly they were just wrong on the expectations for what the future value of this thing was going to be. So, but I mean, I guess that's the upside that the public equity markets look at. And I think, I think it's, the valuation increase that you ultimately get in the public markets is pretty enormous also compared to what happens in the venture rounds. And I think eventually the value creation and the job creation and so forth, there's something going on there that makes these things become worth more money. I mean, some of them get to be just overvalued, but there are some real cash flows that are ultimately generated.
Just a quick tidbit. It's a very good point you make. When you're buying and someone else is selling, in the private business, that's a big red flag. When the company is selling you stock, that's different. But if I'm selling you my private stock, that's be careful. And that's happening all over the place.
Right.
Spin-offs.
We saw it, I think, most dramatically early on with a firm like Groupon, right? If you remember, Groupon took off $300 million of founder shares in second market, which is the private market, and then went public. And I remember actually even with my students, we did this valuation, and they were of course all really bullish on Groupon. And I have to prove, and I was the one in class who said no, they're highly overvalued. And because the students didn't want to believe me, I actually shorted Groupon. So my class made me honest, and they made me money. So I still thank them for it.
You're like Goldman Sachs. You let your students go long and then you short them.
No.
They're going to throw
trust
things.
me.
Throw money.
It's worse than this because I told them that I was going to short it, but that I'm not a financial advisor, so they can't rely on my advice. I'm worse than this. I tell my students that I built a long-short portfolio of my students, so that in 20 years, when some of them will be CEOs of public companies, I know whom to long and who to short. This is my own private public arbitrage.
Your own private market. Right?
Wow.
Let me, joke aside, let me ask you, kind of actually as a final question before we open up to the questions, and before I'm going to ask you whether there's a bubble in public markets, if you actually had the power of agenda setting, in particular, kind of from a regulatory perspective, what would be the one thing that you think, should be changed to help the innovation climate in the US? Maybe, kind of we go down the
Agenda setting. So just generally, if I were president or king?
Sure, if I was king for the...
Well, I would definitely put more into R&D. The nation is still producing amazing graduate students, and that's where most of R&D happens. It used to happen in Bell Labs and other places, but it's shifted now to universities. And I would crank that up big time because the pace of innovation and the speed with which information flows and with which new ideas get spread around. The Silicon Valley lives on two things, many shots on goal and high speed. And that's what we need more of to solve these very hairy problems in healthcare and communications and the, water. Believe me, California, you talk about serious. So we need shots on goal, and so that comes from R&D. They're not all going to work. Your numbers were amazing. I didn't realize it was that bad. But I know in the startup world, 8 out of 10, at least at the level I invest, fail or just get sold off for nothing. But we tried, and that's what's really important. That's what I would change.
And just to follow up on this, but you would, when you talk about R&D investment, you would do it at what level, right? Because we know when the government tries to invest in R&D as a venture capitalist.
Just let the government give us back our money and put it in the universities. That's what I would do.
Yes.
I give you a choice. Either get rid of all the rules from 1974 that divided our society into investors and borrowers, which were the accredited investor rules, which treated wealth as a proxy for wisdom, which is certainly not true. Either get rid of all those rules or bar and ban all state-sponsored lotteries and casinos. Today on the New York subway, I saw the following sign. Your future you wants you to buy this every day. The New York Lottery, win $1,000 a day for life. Were there any disclaimers on that ad? No. $83 billion a year flows from people with an average income of $13,000 to states which lie about where the money's going to go. It does not go to education. Look up John Oliver's piece on lotteries. It's hilarious. But we don't regulate those because the government is sponsoring them. And at the same time, it tells somebody who's merely making $150,000 a year that you may not invest in a private company. That's got to go. That has got to go.
Wow. 83 billion.
I think that I very much agree with you, but I have one little tidbit. Actually, a former student of mine, she did a paper. This is very much in line. So it's just in a way, look for what you wish for, no? So she did a paper on the Taiwanese stock exchange, and she looks at days when there's a huge lottery, okay, like a 500 million lottery win, and you can see actually the stock market volume on those days goes down dramatically in Taiwan. So you see, just to put it a bit in perspective. Vani.
Actually, we're long a couple of lottery stocks.
There you go.
Well, you're in the right place.
But I will say, in all honesty, my parents used to own a retail store, actually in Kendall Square, and they used to sell lottery tickets. And to your point, it's absolutely true what you say, is that whenever there was a big pot, the retail sales and the rest of the store would go down, and of course the commission on the lottery was only 1%, so the margin, I mean, retail basically goes away when you have big lotteries, but it's also a voluntary tax. Admittedly, there's some real socioeconomic issues to deal with, without a doubt, but statistically speaking, nobody ever really wins a lottery, right?
Right.
It's just,
That's right.
It's just a voluntary tax, and if people want to spend more giving the money to the government, it does effectively go in. And it's also a way that governments can actually increase revenue without having to put it to vote, which nobody would vote for anyway. So there is a tremendous issue here. But I think to get back to your question, Antoinette, what would I do if I had to wave a magic wand? I think the most tension I think that we see in companies trying to innovate and fund more development is the tremendous growth in government in all industries and how kind of overwhelming it is. I mean, if you have a U.S. economy, right, that's $14 trillion, government expenditures, and I think it's just the federal government expenditures are like $4 trillion, right? So $4 trillion out of 14 is a huge amount of money. And how that's spent and whether that's spent effectively in terms of innovation and so forth is a real challenge. And I mean, when you look through the market cap of the world, certainly the market cap in the U.S., and you look at industries, large industries like healthcare, right, where government effectively controls most of the money that's being spent there through CMS and so forth. You know, we shouldn't forget universities, right? If you look at the MIT P&L, and you look at the total revenues, I think it's something like $4 billion, of which maybe $3 billion is related to government grants.
Absolutely.
And you know, tuition is maybe $250 million out of 4, of which half of that again is about $250 million is funded by the endowment to kind of give free tuition.
Right.
So tuition is not really what makes MIT run. It's government contracting, and what's the effect of that on productivity of research? So I mean, if I had to wave my hand, I would say somehow how do we I don't want to say make it smaller, but I want to say make it smaller.
Effective.
And
Make
get
it
it
more
sort of
effective.
like, get it back in the private sector. I mean, when I graduated, it was kind of like it was a capitalist society. It's, you know, we're not a capitalist society anymore. And what's the effect of that on innovation? I don't know.
Right. Yeah. MIT is a bit special, right? I mean, we have a lot of government grants, given that we have a lot of DARPA and other grants. That's right. That's also, by the way, why we never shut on a snow day, because the way the government calculates overheads is per day. So when everybody else shuts down in Boston, we will be open. Trust me. Thank you so much. I want to actually open the questions up to the audience, and I hold the last question till after you had a chance to engage. Yes, ma'am.
Venture horizons used to be 20-year bets in the days of Genentech, and it was Pioneer, Bessemer, those guys, and they were very, very long. And then over that period where we saw the funds grow up, it shrank to 5-year bullet paper. Now we have Larry Fink getting up saying we need the public markets to go longer. What do you think the time horizon should be in venture and private equity, ideally, and why?
So in venture, we've got a lot of data. Diane Fraser here probably knows it better than I do, since she's on the LP side of the business. But
That's interesting.
okay, Diana, they're coming for you.
This was a divisive question, Diana.
Anyway,
It's not a bubble.
what would you like to do?
What do you want to do?
You want me to talk over it? Try to talk over it?
Do you want us to talk
Until
over
we
it?
see smoke.
It's in
Keep going.
bits, yeah. In bits. Okay, so
We can stay?
we
Okay.
can stay?
All right.
Okay, cool.
Wow.
Great. So
You're
venture
risking
funds are 10-year organizations. When we were into energy business, John Doerr and I had a conversation about making it 15 years because these things tend to run long. Our healthcare portfolio at Venrock always is longer than 10 years, some of them 14, 15 years. And if it's worth it, you do it because actually in the old days, listen to that, in the 80s, when I joined Venrock, we were more concerned about multiples, not about IRRs. But as the institutions came into the business, the families and the private foundations and stuff, it became an IRR game, which meant you look for opportunities either closer to the exit or just in general had a frame. I don't know what the average lifetime is in a 10-year fund now, but I know it's more than 10 years, which is like, why is that? So you go back year after year and ask for extensions, and the LPs look at you and say, okay, let's see what's left, and is it going to really matter, and all that. But there's an artificial IRR driver rather than multiple driver, I think, based on stuff. But the big deals, I mean, people think Google was overnight success, 7 years to IPO, Facebook, 8 years to IPO. Those are typical of Apple and Intel and all the others. So.
But can I
please.
to follow up on this question though, there are some people, maybe that's in the spirit of the question that was asked, who think that certain industries like healthcare or like energy, right, that the funding model of VC doesn't cut it, right? Because the timelines and the amount of money, amount of capital needed, right, outsizes VC. And if you look at the data, it actually looks like the industry has responded to this by actually reducing the footprint in those industries, right?
That's correct.
That's right. So, what do? Well, first, the correct answer is as long as it needs to be. But it's not that way anymore.
Exactly.
But in health, there's still this illusion that today's health takes as long as yesterday's health company to go somewhere. There are now segments of investors. There are phase 1 investors, there are phase 2 investors, there are phase 3 investors. You don't have to ride the horse all the way around the track, but the VCs are waiting till the horse is in the winner's circle. Our little company started an ETF on New Year's Eve that's focused on 75 small companies under 10 billion market cap with a drug in a phase 2 or phase 3 trial and 2 years of cash. That portfolio is up 36% this year. We're 10 percentage points higher than the Fidelity Biotech Index. Why? Because they invest in the top pharma companies represent 50% of their holdings. They can't afford to invest in the small companies. Our index is only the small companies, which is where all the action is. And the private companies that they used to be are also where the action is, and an investor in those companies didn't have to wait 10 or 15 years because the improvements in clinical trials and in research is moving everything much faster thanks to Moore's Law.
So do you think, is it possible that the venture capital industry has become...
There's an industry that needs to be innovated.
So, but has the process of starting up companies become more efficient, and has Moore's Law kind of created a kind of an acceleration in the ability of things to move faster into the, into the startup phase?
And certainly it has in biotech, because thank you. Now there are companies built around a molecule, not around people.
Right.
So 2 people can be the company. They outsource all the infrastructure, and one infrastructure can deal with many, many companies. This is cheap, it's fast, and it gets you to proof of concept, which in biotech is everything. And since pharma is really bad at innovation, but they're really good at acquiring cash, pharma's coming in earlier to fill their pipeline by making bets earlier in the game in their venture funds. That's a very different kind of venture fund, because they're not investing in somebody else taking it out. They're investing in them taking it out.
There's no doubt speed is really increased, because you can outsource now anywhere in the world. You can find the right server engineer or the right this kind of engineer to do it in India or Thailand or wherever, and it takes fewer people. Amazon's invention of this AWS thing is just revolutionized the tech part of venture capital.
Can I venture maybe a somewhat disruptive question, though? I'm very much in line with all of you about this idea that, with more technology and more the ability to distribute innovation more broadly, right? We get actually better alignment of incentives, right? I'm now running my own biotech firm. It's my skin in the game and my incentives. It's not anymore I'm a line researcher working for big pharma, and if it actually pays off, it's not, kind of my returns, if the drug succeeds. But, we've also seen recently a lot of, how do I say, I don't want to call it fraud, right? But a lot of problems, especially say around health, especially around healthcare trials run in India, trials run in Russia, right? That turned out to be completely wrong. If you think about some of the recent acquisitions by some of big pharma companies. So my question to all of you is: so do you see then this distributed model really as a model where we need intermediation almost of the quality of the investments by big pharma, to make sure that, yes, you have all these distributed innovations happening, but somebody has to ultimately certify that this is a drug, right, that will not kill people, that will actually have efficacy, right? Because, yes, the public can maybe invest in those, but can they really understand the science behind it, right? So my question to you is, basically, who's going to be doing the intermediation of the quality of the drugs?
Well, no matter how big the input is, the output still goes through the FDA. And the FDA has a very small output pipe. So many companies now choose to get approval overseas first to get the patient groups behind them, which are the real intermediaries, because the patient groups have a very different view of risk than the FDA does. The patient groups are very willing to take risk if it's a terminal disease, especially with their children if it's a terminal disease.
Awesome.
He could at least have a question.
I think he thinks English is our second language.
Right.
The other problem is Big Pharma makes a lot of mistakes in this area. They buy things from Russia and China that have gone through a phase 1 or 2 trial that turn out to be very bad. And it's because it's better than the alternative of trying nothing.
Right.
Hi. Over the last investment cycle or so, it feels as if the new age of entrepreneurs have been able to exert a disproportionate level of power that perhaps may not have existed in previous investment cycles or periods, sort of like a Mark Zuckerberg who, with 30%, controls the majority of the direction of his company, Larry Page, Sergey Brin, LinkedIn, a lot of emerging country CEOs who own 80% of their stock in China. Do you feel that this has a net, first off, do you feel that that has been the case based on all the activity that you guys have seen over your careers? And if so, do you feel that this has a long-term net positive or negative effect as we enter a world where entrepreneurs can leverage the true public markets via websites and things like that, where traditional corporate governance models or regulatory reporting elements can't stop them? And an example would be like Airbnb and Uber, which are effectively illegal in many markets that they compete in, but through powerful CEOs who can command huge audiences, can shift elections and continue to do business despite any way to stop them.
Well, you've listed off all the ones I know, too. And I don't know, how many companies were on the market? 5,000? So look, buyer beware, I guess, would be the answer. But you should see what the VCs put in their term sheets. The private stuff. Talk about control and, debt, exits, all kinds of things. So maybe they're just getting back at us. I don't know.
Most CEOs and founders get crammed down, squeezed out, left on the side of the road. The problem with the entrepreneurs you mentioned is we take them too seriously in other areas. So you created Facebook. That does not make you an expert on global health. So you are the CEO of Uber. That does not make you an expert on gender equality. John Chambers was about one thing, Cisco. He never tried to say he was an expert in anything else. Warren Buffett, same thing. I know what I know. I don't know anything about anything else. I don't even know how to give my money away. I'm going to let Bill Gates give my money away. I think it's really dangerous to take somebody who's really succeeded at one thing and assume that they're an expert in the next thing.
I think this is a very wise word for anything in life, right? Unfortunately, it seems though that a lot of startups nowadays need this almost religious glow around them. They are not just providing a ride from here to, kind of Penn Station, but no, they're changing the way mobility works in the US, right?
That's a millennial thing.
Exactly, that's millennial thinking. I think there was a question up there.
I don't know, is this on? Okay. Can you talk to us about the blurring of the lines in asset classes it has on financing at large? For instance, in our angel group, we see larger and larger amounts of capital being raised per company and expertise across many angel groups, venture, private equity, strategic buyers. Can you address that?
Sure. This raising too much money concept is because the VCs have been given too much money. Sorry, Diana. And they have this. They have a business model like anybody else, and so they have to operate within that business model for it to work. Now that I've been a CEO for a couple of years, I see this, and it's sad. We used to say if it's going well and someone offers you money, take it because it's cheap, the cheaper money than when you need it. And so that sort of got extended to this whole, I can only invest $10 million and I want to own 20% of your company. And, you're a startup with 3 guys. What in the world are you going to do with $10 million? So and it sets expectations wrong. And then, by the way, that investor wants to step up when the next guy shows up. So it puts this extraordinary pressure on the entrepreneur and on the company itself. And it can create stresses that are abnormal, I think. I'm not perfect. I'm guilty of it. But on this side of the fence now, I see this is a problem. And this blurring of asset classes, I was the chair of the Texas A&M Foundation for 4 years. And man, I'll tell you, you're so right. It is a blur. And how do you measure these risks in these classes? Maybe that's for MIT's Sloan School to figure out. But it is hard for a layman like me to understand all that stuff.
Totally agree. It's like with children and companies, too much money is a bad thing.
Bernie, did you want to speak to the blurring of asset classes? Or?
How do you see it, Bernie?
Yeah, I think that the asset, certainly in the early stage, to me it seems like it's more about, I think, how do you control the CEO and the founders, and how do you get the ultimate, because if you're coming in with a senior position on the stack, it only means that you have the ability to make a change when you want to, when the default event takes place. And to me, that seems like what it's all about. I think once you get in the public markets, I mean, I think we were talking about this a little bit last night. I mean, ultimately, eventually you want the company to succeed, whether you're a debt holder or an equity holder. If it fails, then sort of everybody's going to lose some money. Most people, the equity holders are going to get wiped out probably. But so I guess from my perspective, ultimately everybody should be on the same page to get the cash flows to pay everybody off, and blurring that with the different asset classes to me doesn't necessarily make it any better.
Thank you. I think there's one final question.
Thank you. I like VC. I'm here. I was a second engineer at Lotus, and I had a client-backed company. Given that, the studies seem to say that 2% of VCs make 95% of returns. That's Andy Ratcliffe's analysis. What's going to happen when 95% of America loses money on small investments?
Well, first, 95% of Americans would love the opportunity to lose money on private investments. Between 1974 and today, the people who could invest in private companies have made $35 trillion of wealth. Everybody else who wanted the same things in life had to borrow to get it. They've acquired $15 trillion of debt. When we talk about wealth inequality, it is all about investing. It's not about wages. It's all about investing. So,
Might be investing.
Yes, people need to know they can lose their money, but it has been a national policy for years to promote home ownership and loan people money that we knew they couldn't pay back in the subprime days. And when you lose your house, you lose everything. You lose an investment of $10,000 or $20,000, you don't lose your house.
Okay.
But we have promoted everybody borrowing money for homes, but not allowing them to invest their money for appreciation.
Thank you.
We've got to balance that out.
Right. I mean, let's balance it out by doing the right thing on all sides, not doing the wrong thing on many asset classes. But thank you very much.
The bubble question.
The bubble question. I let Eric ask the bubble question, given
Go
that
for
I
the
put
bubble.
on. So yes, indeed. In maybe 5 words, do you guys think that we are in a bubble, in particular in biotech and social media?
Yes, I count on it.
No, because he thinks so.
I would say it's a micro problem, but I think there are a lot of bubble stocks in biotech for sure.
Great.
But at the end of the rational drug design, I think, is probably the best thing that's happened. I think that's playing into Moore's Law and all that good stuff. I think there's probably more potential now than there ever has been.
Great. Thank you very much. Let's hope you all sit in the bubble, pinging it from inside, not from outside. Thank you very much, and thank you to a fantastic panel.